What is debt restructuring? Let's talk about it. Company misses the payment, the country's in trouble, banks are negotiating, bondholders are angry, and everybody just says they need to restructure their debt. Stay with me for a minute or two and I'll unpack it for you. Debt restructuring means changing the terms of debt because the borrower cannot realistically pay it as originally promised. So debt restructuring is when a borrower and lenders negotiate this debt. That can mean lowering the interest rate, extending the maturity date, reducing the amount owed, swapping old debt for the new debt, or simply converting the debt into equity. Simply, the borrower cannot handle the original deal. So everyone tries to create a new deal that is less bad than default on that debt. Why restructure this debt? Debt restructuring usually happens when the borrower is under financial stress. Maybe cash flow collapsed, maybe interest rates rose, maybe the company borrowed too much, or maybe the country owes more foreign currency debt than it can repay. The lender has a choice: force default, or maybe recover very little, or renegotiate and possibly recover more over time. That is just the core logic of it. For example, Argentina. A real example in Argentina's 2020 sovereign debt restructuring. Argentina had defaulted and negotiated with private creditors over the tens of billions of dollars of foreign currency bonds. The deal restructured about 65 billion of debt, and it gave the country major debt relief over the following decade. This is a sovereign debt restructuring. A country cannot pay as promised, so it negotiates new terms with bondholders. Or another example, WeWork. In 2023, WeWork reached a deal to restructure more than $3 billion of corporate debt while also raising new capital, according to the reporting at the time. The idea was not that the business suddenly became perfect. The idea was to reduce pressure from debt to buy time. That is often what restructuring does. It gives distressed borrower room to survive. Lenders do not agree because they're feeling generous. They agree because the alternative may be worse. In the restructuring, lenders might accept a lower interest rate, a longer repayment period, new collateral, partial repayment, or simply an equity in the company. And the goal is to maximize that recovery. Sometimes getting less than promised is better than getting nothing at all. So what's the catch? Debt restructuring does not automatically fix the business. It fixes the balance sheet. If the underlying problem is temporary, restructuring can help. But if the business model is broken, restructuring may only delay the collapse. That is why investors ask, is this a liquidity problem or solvency problem? Temporary cash crunch is one thing. A permanently bad business is a completely different problem. So here's the clean definition. Debt restructuring is the process of renegotiating debt terms when a borrower cannot realistically repay under the original agreement. The old debt deal doesn't work anymore, so the borrower and lenders rewrite that deal. The goal is usually to avoid default and recover as much as possible. If you like this explainer, click like and subscribe, and I will see you next time.